go back to a few little basics of a presentation I did a few years back on Fibonacci. So it's not going to take long. I'll just rifle through it. But what you have to understand is that all the ideas and all the kind of trading calls and decisions I make come from this idea of the self-fulfilling nature of technical analysis and how people think within the market. So if you start to understand how people put technical indicators into their charts, then you can start to understand how you can use these indicators and how you can benefit and trade for your entries and your exits. Because if you're not trading in the same wavelength as the rest of the market, you're just trying to trade your own unique set of technical indicators, you're not going to benefit from this really, really important self-fulfilling nature of technical analysis. So really, again, just the basics. So Fibonacci, remember, is the mathematical formula, that represents, the aspects of nature. And then this nature, this idea of proportional movement of, kind of sequences, it works in nature. So you can see your forearm same size as your foot. There's one that I use every time I describe Fibonacci, just to give you an idea of proportions. That human beings have evolved and have grown in such a way that their proportions all meet the needs of a human being. So the markets, when they move, and then the way they kind of, extend higher and they retrace back into previous movements, these again have to work in certain ways. And I can prove this time and time again, because, what goes up will come down, but it's not the way, it's not how it does it, it's the way in which it does it, or the way it interacts. So the basic rules I've used for such a long time now is that 80% of the time, over an extended period of aggressive buying or selling, the market's going to retrace to that 50% Fibonacci. So it doesn't matter what product you're trading, Brent, gold, euro, dollar, the DAX, the Dow now above 20,000. Doesn't really matter. What I'm saying is that if you pick a movement that you can understand why something's gone from the low to the high to the low, it will at some point pivot around that 50%. So you bring those levels into your day-to-day trading. We'll go over in the live charts. But again, understanding that theory behind it is still very, very important. Now, Fibonacci's I generally only go through retracements. So retracements and expansions. So I'm looking for moves and I'm looking to understand where the markets will come back to in order to get out of trades or get into trades. But there are also time zones, fans and arcs. Now, again, it depends how into Fibonacci you are. I don't use these. But again, it's important to understand that there's more than one way to view the Fibonacci sequence in action in the markets. Now, we're always going to really, pivot and really look for these key Fibonacci levels. So the 50% is massively important to me, because that's really the kind of trigger that gets me interested in a trade. But the 38.2 and the 61.8 are also great for confirmation. So it doesn't really matter at what point you get involved in those Fibonacci levels. It's understanding why they've got back to those levels, especially for retracements, and what they're going to do in the future. So many a time, if I know that a strong directional move is going to retrace to 50% and I'm looking to buy a bounce on an up move, for instance, then I might not just buy at the 50%. I might let the market try and extend down to the 61.8 and then give me some sort of confirmation that it's rejected, and then buy back at the 50% because of that rejected attempt to break the 61.8. So again, these are all the little tiny nuances, little tiny things that give you that extra bit of confidence, especially when you're trading fast-moving markets, and especially if you're trading any kind of size. Sometimes about what the market doesn't do than what it does do. That's I guess the point I was trying to make there. So I guess the main point is, when we're looking for any kind of directional move, that the market has broke through this up move that we've gone from this low to this high. We make a slight kind of breakout here, but we didn't close above it. So that, again, that still makes it valid. The market's moved down, resistance at 23.6, resistance at 38.2, resistance at the 50, 61.8, and then this market looks like it's actually going to retrace in time, even go down, because the 50% haven't really come back and tested, and this time we've broke down and found resistance on the 61.8. So again, I wouldn't be buying necessarily expecting this up move to continue, because we broke down below the 61.8 and we've closed below it. So if anything, that's a negative signal to me that the market is not going to bounce back up and recover above this 50%. So in fact, this retracement should continue, and then we probably find the market break below 1492 and then get down to lower levels and perhaps the expansion points that you'd see. So again, it's not about always expecting the market to get back to the 50%. Again, there's more to Fibonacci than that. You can use that as a pivot point or a point of interest. You can be patient, you can be aggressive, you can sell the 50%, you can buy the 50% for any potential, small time blips up. But again, it just goes to show that if you're patient enough and you wait, these things will happen. I mean, the market tests 50% here, and we have a nice bounce all the way back up to the 23.6, we don't make a new high. Yep, so there is a potential to buy that 50% when it the first time around, but then the second time around, it just looks less and less likely the market's going to make a new high. So it doesn't make a new low, then again, you're using that 50%, 61.8, and the low that we've drawn the Fibonacci start from as attraction points. So again, you get two bites of the cherry in Fibonacci. And, these are only hourly candles. You're not having to wait, great amount of times to get profit out or to get back into the trade. So again, for me, what I like about Fibonacci is not just that it gives you an idea of where the markets can go to based upon the retracement levels, but also it gives you the confirmation around that 50%. And again, there's 38.2 and 61.8. Again, not a great deal happens in this area here, but we see plenty of bounces above the 50%. And when we don't see any more bounces, we just see a clean break and the market moves down. So you always got this area of interest between the 61.8 and 38.2, pivoting around that 50%. And that's basically just purely based on this up move. Again, very powerful stuff. So again, just to understand the hourly retracement steps, we see 9 up candles. So if you ever see 9 buying hours, then something's clearly going on. Then we see consolidation between the new highs, slightly been made, but we don't close outside it, so we can still count that. And again, between the 23.6 consolidation, then the market comes back down, and again, it's very quickly that we hit the 50%. The 50% comes a pivot again. We don't make any attempts to make a new high to continue the up move. So if we don't go up, what we're going to do, we're going to go down, make new lows. So again, new clear targets to aim for. So 9 up candles, that's consistent bullish move. I've said to you many a times that we're looking for strong directional moves or very strong extended candles. So again, not difficult to spot in these current markets, especially if you look at the stock markets, the Dow, the DAX, FTSE. If you see any consistent buying, then as we're making new highs in these markets, obviously there will be retracements. So again, the Fibonacci works very well for that. Consolidation, again, there's no kind of magic in here that when you buy, markets up very quickly and very aggressively, people will take in profit, but people will also be loading up for maybe the next leg in the up move. So again, you can look at tools like Elliott wave to see where you are in that up move, to see if we're in wave, 3 or 5, if that up move is going to continue. You're the technicals, straight line support, resistance, overbought in your RSI, Bollinger Bands, etc., etc. Your higher time frames. The market won't continue to make higher highs forever. We will hit a point where the Dow, doesn't go any higher and it starts to come down. It doesn't mean it's going to drop like a stone. It'll probably consolidate and then move a few legs down. And then if the selling inertia gets in, then it's going to really kind of aggressively move back into that range that we've seen, that upward buying momentum that we've seen for many, many months now. And then again, the retracement part of this that revolves around all the Fibonacci levels we mentioned, the 23.6, 38.2, certainly acts as a breaking point, but then acts as short-term support. And then when the market wants to break down, decision points are at the 38.2, 50%, and then we make all our way down, aiming, for that 100% retracement. And once we get below that 100%, you can expect the market really to pick up because all the longs that started that original trend are going to be squeezed out and getting out, so the market moves even quicker down. So Fibonacci time zones are quite an interesting one, and again they use the Fibonacci intervals of 1, 2, 3, 5, 8, 13, so the kind of Fibonacci traditional numbers. So the first line is placed at the extreme point of the chart, like the retracement that we saw, and then move the line down to spread out the arc. Now, Fibonacci fans are a little bit more difficult because you always have this nagging, kind of doubt in your mind that if you've drawn that Fibonacci fan in the correct way. Generally, if it looks right, it is right. And this is why I don't jump on the back of the fans, the arches, etc. so much, because I find them quite difficult to interpret myself, and that's even as somebody who's done that for as long as I have. So if I find it difficult to interpret, probably other people do. So probably less people look at this type of Fibonacci than they do just a very, very bog standard retracements. So again, these time zones work in the same way. So we have, the initial trend, kind of moving up, the consolidation. The trend is then reversing, and then we see the retracement, from 3 to 5. So it depends how you really want to what direction you want to take your technical analysis. If you want to be very aggressive and you want to get involved in the retracement, then the retracement is going to happen later in the Fibonacci time zones. So again, think of it like the Elliott wave. The Elliott wave is identify, correct, continue, correct, make new high. But with the time zones, what you're looking for is once the trend's been identified and made, then you're going to get periods of consolidation and periods of correction. So the correction is going to come later in the time zones. So it's not to say that you can't use these time zones and, you know, maybe you tie it around the beginning of moves, the end of moves, or you tie it with, you know, UK Open, or you tie it with US Open. Again, the time zones are meant to, you know, work for you. Again, I just thought I'd bring this in because it's a different way of looking at Fibonacci. And if you're interested in sequences, you're interested in trading longer term, perhaps, then Fibonacci time zones can give you an idea of how to stay in trades, because you're expecting markets to move, markets to consolidate, and then to either retrace or continue. So again, there's nothing new in trading. You know, it's just another way of using the Fibonacci. So again, the daily kind of Fibonacci moves that we've seen here, we see all the beginning of the move, and then we see the kind of 50% equivalent here, where the market decides that it wants to find some support, and then as each time zone moves along, the market makes new highs. So we go all the way down from 1003 to 1735, and that is, you know, a continuation style of trade using the Fibonacci time zones. And again, I mean, sometimes you can make these things look right, and this is the problem you see I have with it, that you can drag that onto any chart, and in hindsight you think to yourself, well, obviously a trend's going to move and it's going to find support, and then yes, the market's going to move up, and all these lines seem to signify that when the market goes up, that correlates with a Fibonacci time zone. So this is the problem I have with this kind of charting, but it doesn't mean that you can't, you know, put it into your own charts as a secondary, you know, indicator. Then we've got things like Fibonacci fans. Now, Fibonacci fans are the same kind of principle, and they show you, you know, the 38.2, 50%, 61.8, etc., and they show you how the market moves. So we see as the market finds resistance on these Fibonacci lines and the 50% pivot, it moves down, and then when it finds support on them, the market moves up. Again, you could draw that line anywhere you want. You could draw it, you know, to encapsulate this part here, you know, and you could widen the fans. And again, you can make these lines, because they are completely open into interpretation, you know, any way you want. But it doesn't mean that if you are a longer term trader or a trend trader, that you can't use these for that secondary confirmation. And again, you can draw mini fibs in these, your Fibonacci retracements, with the high to the low here, and I guarantee this is the 50% where the market then has gone to move up. So you can combine the fans, the time zones, and the retracements. Again, it's just trying to think outside the box sometimes. Then the arcs, you know, they do look nice. So the arcs are just the same on this down move. You start the fibs here from the highest to the low, and you see that the market is finding support on the 38.2, finding support on the 50%. Yeah, again, getting to 61.8 and going on to make new highs. So in hindsight, you know, you can make these things look really, really attractive. I mean, this looks really well, doesn't it? You know, you find areas of support resistance, yeah, and it really looks nice. Really looks nice. So we can't discount, you know, the Fibonacci ways of viewing it. You know, essentially it is the same kind of idea, just really visualized in a slightly different way. So time zones, arcs, you know, and the fans, they are available to everybody, especially if you use, you know, good quality charting tools like MT4. But really the way I interpret things, which we'll go to in the live charts in a second, you know, I always look at straight lines. I don't want any curves. I don't want any real strong, you know, kind of conflicts on my charts. I like green, I like red. I know when I'm buying, I know when I'm selling, I know when a pivot is. I know my kind of straight line supports. These are the things that really interest me, and you know, very easy to program, you know, when you've got clear ideas. So again, essentially, when you're looking for the markets, if you're drawing a normal Fibonacci retracement, you know, you've got the 50%, which acts as a pivot. Market gets below 38.2, moves down, gets back to 38.2, 50%, acts as support resistance, and it breaks up through the fibs and moves higher. So, you know, fans, arcs, time zones, whatever, they're all essentially, yeah, based around those Fibonacci proportions. But again, they can be visualized in different ways. So when we talk about the retracements, we're talking about, you know, the 23.6 down to the 61.8, and your 0 and your 100 is where you start and end. So after that, you've got your expansion points. So that just means if outside of the upper or lower range of Fibonacci, if a move's going to continue further down like we identified before, then it's going to go to the 161.8, 261.8, and 423. 6.6. And these, again, I'll show you on my live charts, are very important, because these expansion points are where the market where Fibonacci comes into its own, because once you've got, you know, that movement outside of your highs and lows, you don't necessarily where the market's going to go, because you've used your fib, you used your 50% pivot, and you're only going from the high to the low. You don't know what's going to happen in the future, so it's a continuation. You draw your fib from the low to the high, and then you get those 3 bonus expansion points of that move can continue on the high point. If it bounces off the 50%, it will go up to those expansion points. If it's a down move and it holds below the 50% and breaks the low of the move, then you just get your 161, 261, and 423 on the downside, and they can be expansion points. Now I'll show you some of these expansion points in cable. And that is quite worrying, because that means, you know, if we're using the previous move of Brexit, then we definitely break parity. So again, it's open interpretation. It can be smaller term targets, medium and longer term targets. It all depends on your sample of data. But really, what you're looking at is that you get your 50%, you get your 23.6 and 61.8% confirming indicators on the move, and then you get 3 expansion points on the high or the low side when that 50% has actually proven itself to be a true pivot and trigger. So the basic reasons, you know, and the basic kind of rationale behind Fibonacci it is proportions. It's proportion based upon a strong directional move or an extended move, something that's made a significant low and high and hasn't broken and held above it in a good period of time. So strong directional moves will retrace to 50%, and that happens 80% of the time in my experience, and that's a massive, massive edge. So for me, that 50% pivot is one thing that's brought through to my trading and brought through to my charts all the time. Then you can also, you know, bolster the Fibonacci kind of levels, the Fibonacci principles and ideas with other things like your RSI, Bollinger Bands, key support and resistance. And again, you know, you look at the market here, 82, oversold, market comes down, you've got your fib levels, 50% closes below, makes a new low. Again, I mean, that could be as simple as that trade. You know, you get 4 down candles in order to sell the market high and jump on that. And it's not all about getting the full moves down to the retracements or expansions, or, you know, trying to get, you know, 300-400 ticks out of a move. As I said, Fibonacci for me is just a tool to use to get good levels, get confirmation, to get in, and also more importantly to get out, to bank some profit. So if you're getting below the low, you're getting on the moving average, you know, you're getting out when the RSI is coming down, then if you bank these, I don't know, say 40, 50 pips or whatever it is, if you're trading 10, 15, 20, 100 pounds a point, that's more than enough money. And this is where the money's made. All these individual little moves, not picking the low and the high, being involved in the volatility that Donald Trump has kindly provided for the entire trading world. So, I mean, that's just a bit of principle behind it. You know, again, these are things that I've studied for, you know, decades now. And I know everybody knows about Fibonacci, but perhaps people didn't know about the arcs, the fans, etc. It's just trying to get an idea in your head of why I would sit down, you know, with guys that are much cleverer programming-wise than me and make, you know, a series of indicators and charts that could work on any product and any time frame. So when I'm looking at the markets, I'm just trying to look at your coefficients and your correlations. So same, never changes what I look at. DAX, gold, S&P, euro, dollar, the Swiss stock market, FTSE, cable, dollar, yen. So what do we know? Dollar's strong, pound, euro generally sell off. Yeah, simple. That's a nice corner of correlation. Stock market, US is strong. The DAX, the FTSE generally remain strong. If they're strong, that means good favour in the world. It means the world's fairly confident about the outcome. If the stock market is going up, then gold, here in the middle, should be going down. Okay, a little kind of out of the box one, the SMI, which is a little bit more like the Swiss franc, a bit of an indication of risk off trading. But essentially, you know, all we're looking for now is where we can get involved. Where we get involved in the markets, what kind of correlations are going to give us an indication that something could happen? Well, here we have, if we're talking about Fibonacci's, that the market in the dollar, which has remained strong. We've got potentially 4 interest rate hikes this year. 423.6, yeah, the low point of your retracement. 261, 161, 100%, 50%. See, my Fibonacci interpretations are slightly different. I've still got the 50% pivot, which is a dotted white line, but I have my expansion points, and I also have my retracement points set to slightly different levels. So I like to interpret the markets slightly different. So if you look at what is going to be a good one on the hourlies, FTSE. FTSE is a good one. So red points are expansions. So my Fibonacci's are calculated based upon previous movement. So they scan through every single time frame, every single product, and then put the Fibonacci on the fit to do with not just the movement, but also things like, you know, based upon RSI, based upon Bollinger Bands, based upon, you know, some areas of stochastics. So it's not just picking a high and a low. It's taking much more than that. The high and the low is certainly a big part of the calculation, but it takes into account all the other things to try and find the best fit of where you're going to find action in the market. So when the fib lines are drawn, what you're looking for is red areas, which are classed as expansion points around the 50%. Okay, so they're selling points. So you can see how the FTSE's found these selling points. Again, tell me that's not a good level to sell. It gets down back to that 50%, so that's a pivot for me. And then again, you know, the FTSE goes down, look, right down to that 100% line. Then it breaks 100% right down to the 161.8, breaks that. Doesn't get as low as a 261.8, but again, finds good support on these daily, weekly levels, then bounce back up, and it wants to get back to that 50%. So all these fib lines acting as points of interest. Okay, we finally get back to the 50%. Yeah, but we don't re-break and make a new high of these fibs. Yeah, so what do? Come back down, find resistance on the 50% again. So I'm expecting the FTSE to get down to 7169, 7147. Then we're going to get down to 7111.9. Never been happy above 7,000. So 7053. Then below that, 7,000. You know, again, the key psychological, technical level we're going to get to and continue down. Now, the art of trading is obviously being right at the right time. So I've been happy selling the FTSE relatively high below that 50% because, again, historically, we've never been comfortable of 7,000. And although the Dow is making record highs, there's still a lot of underlying fundamental problems in the UK. And it's not the problems, it's just the things we have to overcome. It's uncertainty. So we haven't triggered Article 50 yet. We haven't really got all our trade deals in a row. We've got noises from the EU saying that we can't do any trade deals until we leave the EU in 2 years. And so that all will weigh on the FTSE. So from a technical perspective, a fundamental perspective, you're trying to align them views and just sell the FTSE when it's high, you know, and bank some money at key levels. So, you know, if you're selling at the high expansion points, the red line sell, yeah, then you buy back at your 50% or you buy back at the greens. So again, I mean, it's not exactly rocket science. You know, these are all color-coded to give you an idea of where the market's expanded on the high side and can come down, and when it's overly sold on the low side and come down, and generally it will just go around that pivot. Now, these Fibonacci lines, as I say, work on every time frame, but they will also redraw themselves. So when key rules have been broken, like the higher high, the lower low, the market will then take all that information into consideration and then swap it around. So again, if you just go through the basics of FTSEs, of fibs, we're breaking the expansion points here. So again, you'd expect the S&P to touch 2294 before it makes the decision to go back higher. The euro, I'm always selling high in the euro. So again, red lines, pivots acted really, really well. Just here. Yeah, look all the tops of wicks here, all the rejections above the 50%. So I'd expect easily. I mean, look how the market is zoning in on these lines. So if we start to break 1.068 and then 1065, then the full completion of this Fibonacci move will be 1.06468. So if you're a seller of the euro, then again, draw your own fibs. I mean, you know, some of the fibs that I've already left on previously will be points of attraction. I mean, I think probably the best way is if I just show you a blank chart of something that I never trade. So we can just kind of have an idea of how to use the indicators and how powerful they are. So just find on the list, let's go and do Aussie CAD. Never trade that. So I've never traded the Aussie CAD before in my life. Let's put it on a monthly chart. Monthly chart, monthly template. So what's it telling us? It's telling us the key points of support, resistance. It's trying to give us an idea, yeah, of what the market, where it's been and where it can go. So what you do from this point is you start to go down the time frames, yeah, and start to get a picture of where it's been. So it's been from the low to the high, yeah, And then when you get down to lower time frames, let's put on an hourly template, and we see that, right, okay, so market was quite high, but when you look at the hourly chart, which is something we could trade intraday, the red lines, the expansion points, broke above it to daily highs and came back down. From that point, pivoted around the 50%, doji, indecision, break, 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 all along these fib levels. I mean, look how they hug these fibs all the way down to that 423. Okay, so that's in iView terms, that's a full kind of completion of a Fibonacci cycle. And really, it starts here when you break and close the 50% and don't look back. And look how the selling comes in, and look how we pivot around these Fibonacci lines all the way down to previous levels. Okay, so the whole point of how I've developed iView charts is that it's a combination of your straight line supports where the market's been in the past, so your monthly, daily, weeklies, etc., etc. So I've just put a daily template on that. Then we can look at daily templates or monthlies. So that just fills in more detail. You know, you get the daily, weekly, and monthly. When you put the monthly on, it's just trying to give you that big overlaying outline picture. It doesn't really give you any of the nuances of Fibonacci or that kind of stuff. It just tells you where the market's been. So when you put the daily view in a monthly chart, then you fill in with the weeklies and the daily. So very much like higher time frame trading, where you're trying to figure out where the market's been and where it's going to go. Well, you don't have to do that anymore. You know, iView charts will do it for you. So what you do is then you combine your time frames, you combine your templates for a view that suits your style of trading. So this just says to me that there were so many daily, weekly levels around one spot 0.1151 in the Aussie CAD. Okay, so the market had no chance really of holding above that and continuing this up move. So I'd just be selling high points back to these low points. And then, you know, if you expect a break of these lows here, plenty of support heading down to the low points of the chart at 0.91. So again, I mean, what you wouldn't, unless you're a very long-term trader, start selling here, but then you cycle through the charts to the weeklies and say, okay, yeah, plenty of resistance here, but plenty of support here. So maybe buy for a small bounce here, back to here, or sell. I mean, what it's just giving you is an idea of what the market can do. So if you're selling high on the dailies, 1, 2, 3, 4 selling days, you know, and you're getting out with this clear previous daily, weekly, monthly support and resistance. So it's all about building that frame, isn't it? Like I said to you before. So when you look on your hourlies, well, then it's great. You know, you're selling these good levels and getting, you know, down to these levels, and then you put the hourly, look where this has been, and then you put the hourly confirmation on, then you've got all these levels again that you've always seen from the other templates, the weekly, daily, monthly support and resistance. But now you've got a fib for the hour. So the hourly fib is telling you that it's confirming that when we've rejected the highs of straight line daily, weekly, monthly support, then you sell below the red, you sell below the 50% pivot, and then you get back down. Now there's loads of other indicators, profiles, and setups. I mean, you've got iView charts here. This is just the same view that we had originally, but it's got some bias on it. Okay, so this bias is essentially a combination of D-marker, RSI, and all the kind of lagging indicators that we all love to use, but generally get caught out. So what these indicators try to do is put some forward tolerance. Now, it's extremely difficult to do this. These indicators took years and years and years and years, literally, to perfect, and they're still not amazing. Okay, and when I say not amazing, I'm not trying to downsell them. I'm saying that they can't tell the future. No lagging indicator can tell the future. They're not designed to do that. But what they do is they build up as much tolerance as they can. And again, color coding it to give you an idea that the market is starting, to want to sell off. But you don't sell, until it starts to come back down. So what you do is you look for the really hot spots, like this massive period of red here. And then you think, right, well, as it comes down again into the red, then you start selling, because you've had all the pain here of where you're going to find people getting squeezed out, to the short side, and then as it starts to change through colours and get to the green, then that's when the real selling is going to happen, because people are then looking to buy. So it's almost like turning indicators and oscillators on their head. So again, the same in the DAX. We know the markets, have followed the Dow and gone higher. So you've got plenty of red, but then again, you've got the grey here, the indecision. Yeah. the grey, nothing's really happening. So as it turns to blue and green, that's when you really want to be selling. So it's not, again, as clear cut as, green low is a buy. It is a buy. But what you're trying to figure out is how a market moves. It goes from red to green. Yeah, but you're trying to figure out the life cycle. So again, you've got this selling happening in the green. So what you're looking for is, yeah, the market will be looking to buy soon, but then you're not really looking to buy until you've seen the lowest of green and it starts to move back up. Because at that point, the market's going to continue to sell down and squeeze out any weak shorts. So that, again, I mean, is just another idea of how you can get into the mind of traders and get into the mind of people who use technical analysis like RSI, Bollinger Bands, etc., because they are there for everybody who's a professional trader to squeeze. When you think about a pin bar, a stop grabber, short squeeze and all that kind of stuff, they're all designed by professional traders to indicate they're using tools, liquidity, volume, fast, high frequency trading to get weaker traders out. So if you're trading with a stop around a key level based upon Fibonacci or based upon an oscillator or a Bollinger Band, then the market knows this. So it tries to move the market very quickly through those points to stop you out, because generally you'll be running a 2% risk. So these indicators used in combination, no one indicator on its own is what you should purely trade off. But by using the fib, the higher time frames, by using the indicators, there are things you can do. Now, there are lots of other clever things. I mean, this isn't meant to be, an absolute all-out sales pitch. But, these charts are what I trade my funds off. They're what I've helped hundreds of traders to learn consistent trading, because you've got something to look at every day, that gives you an idea of what, of how you can use charts. I mean, again, all the indicators are down here. So we've got all different things. I mean, we've got a newsreader, for instance. So you put your newsreader on, then that's going to give you all the news that's coming up. So let's make it a bit clearer. Yeah. So what we've got is, in a minute, we've got the unemployment claims. Yeah. High impact tells you what it is. So you don't even have to look away from your charts anymore. You're reminded what's going to be coming up, what's happening, what the impact is. Then you've got plenty of other indicators that you can add, from an iView perspective, to give you, an idea of what the market's trying to do. Another one, it's just a simple grey area. So really what it's saying is, you need to be selling high. Yeah, this is, again, this is different from the bias. Selling high and then staying out when it's grey. So high point sell, high point sell. That's in the monthlies, but as you cycle through to the weeklies, you get less clear signals. Yeah, the grey just means stay out because there's no real advantage to you, but the blue just means a change in trend. And you don't, again, you don't get to see all these indicators very often, but there we go. On a 4-hourly chart here, you see the market is ready for a sell-off. So when you do see them, you want to get involved. So the market goes high, yeah, and as I say, you're waiting for that selling to happen, but it's always dangerous to do it at the highest point. But then the market again moves up one final test. We use this weekly resistance point at 100836. Then the market bang comes all the way down to where we were looking at. Yeah, so that's another indication. And as I say, you don't get to see them too often. The red, the grey area is saying that we're moving towards a trend change. The market comes down. So it is extremely difficult to create indicators. Let's just put the bias as well, because sometimes what I like to do is you're trying to figure out, the difference between the grey area and the bias. And again, what the markets will show you is that there is a difference. So there is some correlation between, where to stay out and what the market's thinking is going to happen. But as the market kind of gets to the highs here, we see the kind of trend change match. But you're not actually, looking to kind of get aggressive selling until you see some kind of green. So again, that's when the market comes down, but then pushes back up, and then the market starts to come down. So when the more green you see, the more the market drags down into people buying. So obviously, it's down to interpretation. As you cycle through the charts, you can see how it builds up areas that we are getting high. Yeah, but then the higher the time frame, the stronger the signal, but the more time it makes to enhance. So you start to think about selling here, then you get short here, and then the market finally starts to really sell off when we start to get green. So again, it is all down to interpretation, using the time frames for your own trading, and it is all about understanding, where you want to be involved in and what kind of combination of indicators you want to use. As I say, it's a fairly simple. It looks fairly simple, but it was incredibly difficult to make it look that simple because it's more about what you leave out than what you put in. And there's so much that you can look at MT4, indicators or different pieces of software out there, and they try to make it overcomplicated. I've just used things that have made me money over the last 15 years. Simple as that. So there's a combination of higher time frame, a combination of Fibonacci that's automatically drawn, and if you want to, adding on some of my kind of oscillator-based indicators that give you an idea of potential shifts and changes in direction. So as kind of packages go, it's pretty complete. As I say, it gives you that consistency that you look at the charts and you start to look at fibs, and all you'll look at is fibs and straight line support. I'm a buying here, I'm a selling here. If it breaks here, where's it going to go to? Where's it been in the past? Again, you can turn on your news feed. There are other tools that you can use, but we probably haven't got time to go through them all. But again, it's a fairly comprehensive package that works on any time frame and any product on MT4, which I haven't seen many things out there that do that. I've written products for tradable, meta stock, and this is far superior. This is what I use day to day when I'm commentating on the markets, when I'm trading the markets. Anything I do revolves around this system. So as I say, this system comes for free. If you want it, all you've got to do is open an account with InterTrader and put more than $5,000 in. If you don't put more than $5,000 in, you're probably not going to make it as a trader anyway, especially with the FCA regulations that have been proposed that are coming into effect in the next kind of 6 to 12 months. Above that, if you want to put some more money in, then you get access to my time, my mentoring service. I've taken people from all sorts of walks of life, all sorts of backgrounds. I have traders that make £20,000 a week. I have traders that make consistently £4,000 or £5,000 a month, with varying kind of account sizes. I have traders that don't listen to me and invariably don't make money. I'm not a miracle worker, and my time is precious. Damn expensive. So if you want to put money in back yourself and using a reasonable account size with my charts and my help, your chances of success are much, much greater than just trying on your own. Pretty simple. I'm expecting you to open a trader account with InterTrader because I'm the chief market strategist. I flew over to London to meet them, meet my new PR team, etc., etc. I've been there 7 years. It's where I trade my own funds. It's where I'm comfortable. If you're a larger trader or a high frequency trader, I will give you special rates. I will help you have personalized swaps, personalized spreads. You can do anything. We're a truly market neutral broker that doesn't trade against you, and 90% of other brokers do, and that's why the FCA regulations have come in to stop this misappropriation of trading firms' power. So what you get is you get charts, you get my time, you get a trading firm that doesn't trade against you, and their only vested interest in you making money, and that's it. That's as simple as that. I'm not really one, as you've known, because I've done a lot of webinars, 1,200, 1,300 webinars over the years. I'm not one for selling. This is a mentoring package designed for serious traders that want to make money. I don't want to just sit here having conversations with you about, what you're having for tea. It's not like that. We're meant to be serious traders. Of course, we can have some banter, but we're out there to make money. And by using my chart setup, you get the consistency, and you'll be able to view every market, like an absolute pro. Like somebody who take all the emotion out. With my help, I'll help you interpret the fundamentals, which are driving the markets, especially politically driven now. And again, I can help you with risk management, money management, all the things that the books can't teach you, essentially. All right, guys. Well, I'm very wary that I don't want to keep Simon with his code waiting too long. But is there any kind of questions or anything people would like to ask or?
Steve, that's very kind of you. I've had a limb sip now, so I'm feeling a lot better. 1 or 2 questions waiting. First of all, just to confirm, you have been looking at live charts. These are live markets at the moment.
Absolutely, yeah.
Zachariah says, "Hey Steve, what algo are you using to calculate your fib lines?"
Well, it's a combination, as I said earlier on. It's a combination of market movement based upon the time frame, and it takes into consideration other factors, that are correlated with RSI, Bollinger Bands, and other kind of lagging indicators. I can't just tell you what the the algorithm is, because it's mine. It's absolutely individual. It's my IP. It's no, I could tell you, but I have to kill you type stuff.
Yeah. He says he knows now because he was late in and he didn't realize it was iView that we were discussing. That's no problem at all, Zachariah. Martin says, how does this work on small time frames, please?
Well, it works on exactly the same way on small time frames. I mean, the whole point is, if I'm looking at gold, for instance, then, for me, intraday trading, I start on dailies, and then I move across to the hourlies. This is where you get your strongest idea of what the market's trying to do, and then you move down to your smaller time frames, 15-minute and 5. So, again, you could quite easily put, your 5-minute fibs on, and this is where the market starts to get a little bit more jumpy on the 5-minute charts, but you see how the 50% pivot, bang, 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 and the 423 spot 6 acts as perfect resistance, then the market moves down. But this hasn't redrawn yet because we haven't had the right combination of movement. So this is just saying that now we're below the 423, it's extremely bearish in this market, which ties in with my gold view absolutely. 15%, same thing. We're below the 423 spot 6. So we're just using our straight line higher time frame levels as points of attraction. So 1180 spot 2. That's what gold's going to get to, I would say, before it moves higher. But yeah, it works in exactly the same way. All the indicators are all time sensitive and they redraw themselves based upon movement. So again, until there's been a certain combination of movement, the Fibonacci's won't redraw themselves on this. But you can cycle through any product. They're all set up the same way. So DAX, for instance. So DAX working very well on the 5 minutes. Yeah, look at that really nice level here at 118.56 spot 1. Market then goes down. So ultimately, if you think the DAX is going to continue further on the smaller time frames, these are your targets. Again, looking quite nice on the 15 minutes, 50% acted as quite a good pivot. Market moves down. But on the hourlies, we're actually massively oversold. As you can see, look at the sea of red. So the hourlies are being pushed up. But now, as we've come out of this red zone, and we're showing some green on the smaller time frames, this is where, again, you want to see the real selling happen and be buying low dips because the overall trend is up. If you look at the monthlies, well, I'll probably just change that to a daily. You look at the dailies, the trend is up. So it's trying to figure out where you are in time. As I've always said, trading is about being right at the right time, not having the right kind of opinion. So, the market could drop like a stone, but I'd still be buying dips because the overall trend is up. But then, you might interpret my charts differently and say, right, well, we're looking very overbought on the hourlies. So what I'm going to do is look at these smaller time frame fibs and sell some little breaks, and maybe on the 5-minute chart, nick 12 ticks here, or maybe I'll go down to nick 30 ticks. As I said, if you're trading size appropriate size, then 10, 15, 20, 30 ticks is absolutely fine for an intraday trade. So you have access to trade everything with this setup, or you can just look at the charts as an overview, or you can use the templates to do whatever you want. You could set up charts just like I have done in half an hour. It would take you probably months to do that if you were doing it manually. So this is the whole point. I'm using technology to save time. You can look at any chart, any time frame on the click of a button here. All you have to do is select a template. It's all done for you. The combination of how you put it together and how you view it, again, can be entirely up to you. You can use my view, which is again included, or you can just default, set up, a blank workspace and just do it however you want. Put whatever charts, whatever time frame. And this is the whole point. You can make it look however you want, with a click of a button. And I'll show you how quick it is. If I want to be looking at the pound, for instance, then what do I want to be looking at? I want to be looking at pound, bank, close, window, tile, hourly. Right? So that, again, if I'm trying to do some quick analysis of what the pound's doing, pound against the Swiss, looking pretty weak, pound against the euro on its way down, pound against a little bounce. Okay, bounce. So probably I'd let the euro get down some low points and start buying the pound. Well, sorry, selling. Selling. So obviously, weaker, stronger, weaker. So you're looking for correlations between these and then picking out, the right kind of product for the right kind of trade. So this continues, to bounce up. The pound's getting stronger, and so maybe there's good opportunity to start buying, the pound against the Swiss. Again, you can use it however you want. I'm just trying to show you or indicate, what kind of speed of kind of agility you can have within the market. So, you're not kind of tied to thinking, oh, well, I want to trade something now. What should I do? What time frame should I look at? What products and indicators going to suit this? You can just put your templates on, and pretty quickly, on the space of 30 seconds, you can adapt the markets to your kind of view, and that kind of speed of movement, especially when you're trading data or you're trading after big comments, it's great because the lines are always there for you. You don't have to think about where the market could go or where it's been before, because they're always plotted out. Yeah, no matter what the template is or the time frame, you always got that backup of where the market has found support and resistance past. So the fibs are just more of an indicator of what's happening now on that time frame.
Thanks, Steve. Staying with the fibs, what sort of margin, asks Harvinder, do you work with when determining that a certain fib retracement has held or has been broken?
Well, I mean, again, it's the factor of time. That's what Fibonacci is all about. It's once you identify the right kind of move, as long as you've identified the right move, which I do, probably 80–90% of the time, then it's just being patient. That's your margin for error. It's being patient and waiting. If you see the Fibonacci's on the 5 minutes, they're going to take less time to interact with that 50% and hit the upper and lower boundaries. If you're drawing a Fibonacci on a daily, of course it's going to take longer. So what you're trying to have is something that stays on your charts for a time appropriate amount of time before it's redrawn. And that's what the algorithm does. It finds out on the time frame what the best fit is, and then it waits until the Fibonacci has made a new low or high, then it decides if it needs to redraw. So the margin for error is just time. I mean, if you just go through the charts, especially on the hourlies, and you just look, it works time and time again. I'm not here to prove anything. If you put $5 grand into an account, you don't have to trade. You can just look at the charts and watch them and see them interact. The whole point about trading is it doesn't trade for you. It just gives you all the support you need to have the confidence to get involved in the right areas. As I said, being right at the right time is no more complicated than
that. Thanks, Steve. Joaquin says, can you show us again how you place the fibs, please?
How you place the fibs? Okay, what do you mean? Manually or?
Yeah.
Okay, well, again, it's all based upon movement. So if you're trying to figure out, anything, let's just take coffee. I don't trade much coffee. So you've got a blank chart here. Okay, so we're going the monthly. Well, the monthly is rubbish. Okay, we're going the daily. So, okay, I can tell you right now that's a 50% fib. How? Well, the market's gone from the highs to the lows. Haven't made a new high. Haven't made a new low for this point, so the Fibonacci is in place. What did I say? 50% of the time it gets back to 50%. Well, there we are, 50% on the dailies. So moving down, rejected down. So then you've got an absolute key point. You've got this key point here in coffee at 153. If it doesn't want to go any higher than that and keeps closing on the dailies, then it's going to target lower points. 148, spot 88, and then break down. So all you just do is look on your hourlies, see how that plays out, and here's your levels. Sell high, yeah, or maybe buy some dips low. That's how you draw Fibonacci's. Strong directional move, something that looks right, that hasn't made a new high or a new low. Then you bring that chart into the future, and then you don't know what happens here, but you've got an idea where it's going to go.
Okay.
Okay. Anything else?
Yeah. Gasly, I think I'm hoping I'm pronouncing that correctly, says, do you have to select your instruments, or does iView charts scan for potential candidates?
Well, I mean, again, it's entirely down to you how you set it up. I mean, if you know how to use MT4, that's a big help. We have profiles here, which is a series of charts. Okay, so charts set out in different ways. This is my main view, all the windows. But then you have your templates, so you can put any charts in a profile, but then set them to have any templates. So the templates are either time based, or you just start a blank chart, as I've shown you before, and just add indicators that you want. So you just start, first of all, you make it a blank chart, so it looks nice, so you get some information from it, and then you insert your indicators that suit you. So you just go say, I want bias. Okay, so the bias goes on. Then you want the Bollingers and the fibs. Okay, so then again, you're starting to make the chart look however you want. You're just getting involved. So then you just drag the product in that you want, and just even see what looks right. That's how easy it is. That's how quick iView changes to the different markets. Any product you want. So that's just 2 indicators on. Yeah, and you're starting to get an idea. New Zealand dollar against the CAD. Bang. Red, sell, buy, buy, buy. Yeah, look at it. It just works on every currency pair. I could do all day and go through. But, how can you interpret this many markets this well on your own? Why would you? How could you? So again, I'm not saying it's like some revolutionary product that, it's going to change the world of trading. It's not designed for that. It's meant to give you this framework of what's happened in the past based on probability and my 15 years of trading. What's made me money is these green and red lines. So respect them, use them, get involved with them, and just watch them over time, and you will get confidence from the consistency that it gives you. Okay, anything else?
Okay, 1 or 2 questions. Sandor saying, what is the 432 that you mentioned? Is that a level?
The 423.6. Yeah, I mean, the way I draw my Fibonacci's is they're based upon fibs and expansions. So I look at this that I'm always trying to be market neutral to a certain extent, that I don't want to kind of have an opinion that something's going to go up. Now, we're human beings, so we can't. I've got opinions that the euro's going to go down, the gold's going to go down, and the pound's going to go back up. That's something I can't get away from. But intraday trading, I'm trying to be market neutral. So the way I draw my Fibonacci's is I'm looking for that 50% pivot. That's the constant. That's where I like to get involved. So my Fibonacci's are then almost hybrid, and they revolve around expansion points, yeah, but also retracement points that are based upon the expansion style of moving. So stay with me here. It's not as complicated as it sounds, but the Fibonacci levels that I've said, the 23.6, 50%, 61.8, are hidden within the code and hidden within the movement. So I put the green and red lines as more of a guide to the fibs, so that my interpretation of a Fibonacci retracement and expansion cycle to the up and low side. Okay, so it sounds a bit complicated, but it's not. So what I do is I take out a lot of the noise and I've streamlined it just to say when it's red, it's selling. When it's pivot, it's either going to go up back to the red or down to the green buy lines. And again, you don't necessarily have to buy at the green lines. They're just saying that once that 50% pivot is held, those green lines are targets for the market to go down. So you can sell each one to break, or you can buy little dips. It's entirely down to you. We're trying to be market neutral, trying to make money no matter what. So buy it a bit of green, sell it a bit of red. It's not about long-term view for me. Okay, that's where your fundamentals and your higher time frames come in. For me, it's about making money intraday, and on the hourly down to the 5-minute chart, that's what the green and red Fibonacci lines are meant to really kind of bring through. That these are opportunities to get involved in the market.
Okay, what about if you put a £5,000 deposit into the account, asks Gasley, is there any pressure to trade until you're comfortable after playing with the charts?
No, there's not really any pressure, to be honest. I'm tired of giving things away. So if you're serious about trading and you want my charts, you can have them for free and you can try them out. And if you don't like them, then take your money out. I mean, the charts don't really bother me, to be honest. The charts are there. They've been paid for. The thousands of man hours that I've kind of paid for to have them created. They've been paid me back at 100, 1,000-fold. So I'm not interested about people. I used to give the charts away for free, but I don't see why I should give things away for free anymore. So yeah, if you put £5,000 in, you can have the charts for free. But what you don't get is any of my time. Okay, but if you want to take that to the next level and maybe put 10, 15 grand in, you can still keep the charts if you want. But then you're going to get infinitely more successful at trading by speaking to someone that wrote the charts and somebody who trades, for a living. So again, it is what it is, guys. It's kind of, if you want the charts, give it a go, put £5,000 in. If you don't want the charts, then don't. Just come and watch the free webinars where I use the charts. Simple.
Fantastic. One final thing, where do we get the German DAX? That's on there.
Well, it's just the DE30. So the DE30 is the DAX.
Okay.
So, I mean, every different broker has slightly different mnemonics for their MT4 products. For what reason, I do not know. But on Intertrader, the DE30 is the DAX. US 500 is obviously the S&P 500. The commodities are pretty simple, and so the FX. But yeah, I mean, Intertrader provides on MT4 all the main markets, I ever want to trade anyway.
Okay. Is this offer going to be there in the future? Because I don't have that sort of money now. Ask Zachariah. I believe that this is it's not a time limited offer, is it, Steve?
It's as long as I'm breathing and trading the markets, that offer's open ended to anybody. If you're really serious and you don't have the cash, I'm not averse to giving you a trial period. I'm not a monster. At the end of the day, the £5,000 there is just to stop time wasters. I'm not a charity. I'm not here, just to kind of. I help people enough with the free webinars, so this is the more serious side meant for people who want to get better at trading. And maybe you're a good trader and want to be exceptional. That's really where I excel. If you've got anywhere over £25,000 to trade with, and you've traded in the past and you've traded okay, this is where I have the best results. Because I'm a professional trader, mentor, risk manager. There's lots I can bring to the table. It's not really a kind of hand-holding, teach to trade type thing. But again, if you put £5,000 and you want to learn the charts and invest your own time, that's absolutely fine. That's a good way of learning.
Great. Well, thank you to everybody that's emailing in to tell us that DE will stand for Deutschland, of course. So the Deutschland 30, DE 30. There we are. Thank you to our German viewers and international attendees. Thank you, says Zachariah. Now, Godwin, you're leaving your number there. I've actually posted a link into the chat box, London Investment Week /Ruffley. If you go to that, click onto that link, you can just fill out your details there, and someone, or maybe even Steve himself, will get in touch with you.
I'll personally do it. Yeah, I mean, the reason why, obviously, I've known you for a long time, Simon. So we know we have a good crowd of people on the London Investment show. So yeah, I'm happy to anyone that's serious about it. Give us your contact details, and we can have a Skype chat and we can go over it. But again, if you want to Google or you want to get I mean, there's a lot more to this. So again, just kind of the initial point is to register your interest, and I'll send you some more information. And if you're serious, we can have a one-to-one chat about your needs.
Fantastic. Well, Steve, thank you very much. We're just coming up to 2 o'clock, so I think we'll leave it there for today. And you're going to be back again next Thursday. We're going to try and turn these into a regular Thursday lunchtime update.
Absolutely, mate. I think what I'll do is we've done the kind of Fibonacci side of it, so I'll bring some other kind of iView tools in, and we'll just have a general kind of overview of the markets. See what's happening with good old Donald Trump and what's happening with his relationship with May, the EU, etc., etc. And just trying to build up some confidence with people, and we can show how the markets are going to move, whether they're going to be short, medium, long term, and get people making some money. That's why we're here.
Great. Well, we'll look forward to that. So, well, on behalf of everyone, until next Thursday, Steve Ruffley, thank you very much indeed for joining us.
Cheers, Simon. Thank you.
Many thanks. Thank you again. And just to confirm, everything has been recorded, so we'll get that off to you as soon as we can. Okay. Bye-bye for now.